Hello and welcome to this Prepare to Pass series on financial management. My name is Waleed and I teach this paper and the advanced version of this paper at PwC's Academy in Dubai. I've put my contact email there on this slide, and if there are any questions post this revision series, please feel free to get in touch with me and I will try to get back to you ASAP. Few important links. We will be needing the extra constructed response workspace today. So I would appreciate, while I'm going over the topics, if you can open the first link, which is the FMCBE specimen and extra constructed response questions. Here is our plan for this revision series. We are already done with session 1 on investment appraisal, which I hope that you would have enjoyed. Today is another really exciting day on business finance. So we're going to spend a few hours talking about business finance and then go into working capital and valuations and risk management later. So that's what we covered on day 1. We did some question practice on HIBAC and PELTA. We went over key investment appraisal areas, and then there were some extra questions for you here, which you could have done as part of your home assignments. So here is the plan for today's session. As the first session, we are going to go over some key business finance concepts. And after going over key business finance concepts, we will jump straight into some question practice. The aim is to get through 50 marks. But if we are anywhere close to that, which is good, and you can do a bit for the homework as well. Now, I have again chosen 5 really good questions, which would be ideal for you to do in your preparation for the March 19 exam. I will be planning to do the first 2 to 3 questions on this session. If the time permits, we'll go into the third one, or at least we'll try to cover the first 2 questions on this webinar. So the questions are AMH, which is June 13 exam. I've taken the full question, the original question was 25 marks, but remember in your section C in today's time, you could only get a question with 20 marks. And we'll also have a look at question KQK, which is September-December 15 exam, which was 15 marks originally. But remember, you will be examined on questions worth 20 marks. So here is the plan for the session. And as always, without wasting any time, we can go into a bit of an overview of business finance here. So within business finance, our aim, or the major area for today, is to look at cost of capital. And within the cost of capital, we can think of the idea of WACC. So our aim for this session is to go deeper concepts on cost of capital, which then will create many of your questions or confusions which you may have around this area. So let's think of this. So we are going to focus here on cost of capital, which is within business finance. As this topic is a core area in financial management, this topic can feature anywhere in your exam. It can be few OT questions in section A, it can be a brief scenario in section B, or it could be a longer question in section C. So very, very important area for which we need to be prepared. Now, within the cost of capital, and when I say WACC, which is the weighted average cost of capital, what we see in our formula sheets is a really nice and beautiful formula, which looks something like this. So we've got a nice formula on the formula sheets, which looks something like this. So that is the WACC formula in the formula sheets. Now, before we do anything else, let's just try to simplify this formula and try and understand that what is this formula trying to do for us. Now, if I take the value of equity of a business and divide it with the value of equity and the debt. So this is the value of equity. This is the value of debt. So value of equity and value of debt. So if I take value of equity and divide it with the value of equity and the debt, what I'll get here is the proportion of equity within my capital structure. And once I have the proportion of equity here and I multiply it with the cost of equity, I will get the cost for having for raising equity finance. So proportion of equity into cost of equity will give me the cost I will pay for raising equity finance. Then on this side, if I have the value of debt and I divide it with the value of equity and the debt, so that is VD over V plus the VD, this gives me the proportion of debt within my capital structure. And once I have this proportion of debt, if I have the proportion of debt within my capital structure, what we can then do is we can simply multiply this with the cost of debt, the KD1 minus the T, the cost of debt. So proportion of equity into cost of equity, proportion of debt into cost of debt. When I add these two, I get a cost for raising my equity and debt financing. So what we do in the WACC is simply sum of percentages of equity and debt multiplied with their costs. And that's it. This is the WACC. Percentage of equity and debt multiplied with their respective costs, and then we take a sum of it. Now, the next question is, where do we use the WACC? So the WACC can be used primarily to discount relevant cash flows of a project to find NPV. So it can be used to discount relevant cash flows of a project to find the NPV. Now, this is a revision series, so again, I'm hoping that you've gone over the tuition phase on this course. Can you comment here and tell me where else have you seen the WACC being used in your syllabus? Can you just leave a comment in the questions box and tell me that where else have you seen the WACC being used in your syllabus? So one use is that we use it to find the NPV. Where else have you seen the WACC being used in your syllabus? So I'm waiting for your comments here. Where else have you seen the WACC being used? So I'm getting few answers now. Business valuations, yes, that is right. Where else? Business valuations, yes, I agree. Ratios. Ratios. We don't really discount ratios unless you tell me which ratio are you talking about. But yes, business valuations, I agree with that. Business valuation. CAPM doesn't use WACC. CAPM doesn't use WACC. So, yeah, few right answers. Let's just think about it. The other uses of WACC, the other uses are in valuations, as a lot of you have pointed out, which I am okay with. CAPM, no. So other uses are in valuations and also in IRR as a decision rule criteria. Because if you remember, we say that if the IRR is greater than the current cost of capital, we will accept the project, or if it's lower than the current cost of capital, we'll reject the project. So that criteria is basically your cost of capital. Yeah. It is also used in discounted payback. Also used in discounted payback and within sensitivity to find NPV, which we already know that it is being used to find the NPV. So we use WACC in quite many places. Any questions on valuations? We will cover that on the last session. But remember, today's focus is only on the business finance. So here are a few uses of the WACC. We use it in NPV. We use it in valuations. We'll see that on the session 4. We can also use it in IRR as a decision rule criteria, and finally in discounted payback, and also within sensitivity analysis when we find the NPV of something. How do we find NPV? Again, by discounting the relevant cash flow. So quite many uses of the WACC. Now, what I want to do here is, I want you to tell me that, is this the comprehensive WACC formula? So is it the WACC formula which can be used for any kind of source of finance? Or is there anything else we need to look at here? Is this the comprehensive WACC formula, which is given in our formula sheets? No, yes. No, no, yes. Okay, good. Yes, this is not the comprehensive WACC formula. Because what I want you to understand here is this thing, that when we look at the sources of finance, yes, the sources of finance are primarily equity and debt. But within equity and debt, there are different sources of finance. The first source here is the ordinary share capital. The second source here is the preferred share capital. Now, these are the two sources of finance which are within the equity side. There are also some other sources of finance when we look at debt. Within the debt, we can have bank loans. We can also have redeemable traded debt. We can have irredeemable traded debt. And we can also have convertible debt, which can be traded. So there can be 6 sources of finance in our syllabus. Which means the WACC formula will be extending. Now, what we need to do in our syllabus is that for each of these 6 sources, we need to find their values. And we need to find their costs. So we need to find their values and we need to find their costs. That is our aim in the syllabus. Now, when I say values, we mean for the ordinary share capital, we need to find the value of equity. Preferred capital, we need to find value of preferred capital. For the bank loan, we need the VD. These are all different VDs. And we think of the cost, we need the KE here. We need the KP. We need the KD1 minus the T for the bank loan. We need the KD1 minus the T for the redeemable debt. The same for the irredeemable debt, and the same for the convertibles. So all these are different calculations. Now, the sad part here is that the WACC formula sheet, the formula on the formula sheet on the WACC only shows 2 sources of finance, assuming that there is one portion of equity and one portion or type of debt. But it doesn't show you that the equity can be 2 types and the debt can be 4 types. So in the overall scheme of things, we need to be able to calculate all these. Now, would you have to calculate all 6 of these in the exam? Well, no, I've never seen that. The maximum the examining team has gone up to is 4. The maximum examining team has gone to R4. Now, if I tell you that a business is using ordinary share capital, a business is using preferred capital, a business is using some sort of redeemable traded debt or redeemable traded bonds, and the business is using bank loan. Now, if the business is using 4 of these sources, then our WACC calculation will be different. And our WACC calculation now will be looking at something like this. For example, we'll say value of equity, VE plus VP plus VD plus VD, the two types of debt, the bank loan and the redeemable bonds, into the KE plus VP, VE plus VP plus VD plus VD into the KP. So these are the two portions in the WACC formula. Assuming a business is using ordinary share capital, it is also using preferred capital, and then it is using two types of debt. Now, the two types of debt are, first of all, let's say the bank loan. So this is the loan. So VE plus VP plus VD plus VD into KD, 1 minus the T. And it is also using some redeemable bonds or redeemable debt. VE, VP, VD plus VD into KD, 1 minus the T. Now, this is what we need to understand. If a business was using 4 sources of finance, which are ordinary shares, preferred capital, bank loan, and the redeemable bonds or the redeemable debt, then this is how the WACC formula will look like. It won't be the one which is given in the formula sheet, which just has 2 sources of finance. Here, we are looking at 4 sources of finance. We're looking at 4 sources of finance. Now, what we are going to do now is we are going to look at ways in which we can compute all these values, which will give us the proportions of these capitals. And then we will look at ways in which we can compute the costs for these sources of finance. So we'll look at ways to calculate the values and look at the ways to work out the costs of these sources of finance. And then eventually, we will look at a question which will use 4 sources of finance, and this is the calculation we will need to do on that question. Now, let's start looking at the calculations here, and let's do the values part first. So how to find the values of equity and debt. Values of equity and debt. And I'm assuming here that I'm working in market value terms. Market value terms, because they are more commonly examined market value. Book values are really easy. They're historic, they're in the SOFP. Now, the first thing is the value of equity, which is for ordinary share capital. When we think of value of equity, what we need to do is we need to take our share capital in dollar terms, which is in the equity portion of SOFP, and divide that share capital with the par value of the shares, or the nominal value of the shares, or the face value of the shares. All that means the same thing. Par, nominal, face. Once I divide my share capital in dollar terms with the par, nominal, or the face value, what I will get here is the number of shares. And once you have the number of shares, then you simply multiply it with the market price per share. And that gives you the value of equity for ordinary shares. Value of equity for ordinary shares. So that's how we find the VE. If you have to find the VP, which is the value of the preferred share, then what you will do is you will take the share capital for the preferred shares. Remember, in our SOFP, the ordinary share capital is different. The preferred share capital is different. They're not the same. The ordinary share capital in dollar terms is different. The preferred share capital in dollar terms is different within our equity portion of the SOFP. So here, we'll take the share capital in dollar terms, which is the preferred capital, preferred share capital. And this is the ordinary share capital. So once we take the preferred share capital, we'll divide this with the par value, nominal value, face value, whatever you may need to call it. This is the denomination of the shares. And this will give me again the number of shares. And once I have the number of shares, I will multiply it with the market price of preferred share. So you need to develop an understanding here that the market price of the ordinary shares is different than the market price of preferred shares. So it's pretty much same calculation for both, but the only difference here is that in the above calculation, the VE, we are talking about ordinary share capital. In the below calculation, we're talking about the preferred share capital. And we're talking about the market price per share ordinary and the market price per share preferred. That is how we work out the VE and the VP on market value terms, VE and the VP. Now, the next thing is the VD. So VD of the bank loan. VD of the bank loan. Now remember, the bank loan is non-traded. The bank loan is non-traded, which means it does not have a market price. So the VD of the bank loan, or the value of debt of the bank loan, is simply the long-term debt from SOFP, which means that the book value of the bank loan equals its market value. Because it is non-traded, there is no concept of a market price. So whatever it is in book value terms, the same it is in market value terms. So we will see a question very shortly. We'll take all these values. I'll show you how to extract them from SOFP. But I just need a brief understanding here that when we think of VD of the bank loans, we simply take their value from the SOFP within the non-current liabilities. And their value, the historic value, is also their market value because they are simply non-traded. Then the VD of the redeemable traded bonds. Redeemable traded bonds or the debt. Now, because these are traded, therefore they will have a market price. So what we need to do now is to take the book value of these bonds, and we will find the book value of these bonds in the SOFP. We'll take the book value of these bonds, and then we will divide this book value with the par value of the debt. Now, the word par value, again, is nominal, face value, all same. But the par value of the debt in our exam is always $100. So the debt is broken down into units of $100. So we'll take the book value, divide by par value, which will be $100 in our exam, and we'll multiply this with the market price of the debt. Market price of the debt. And then that's it. So book value over par value, which is $100, will give us the number of debt, the units of debt. So this here will give us the number or the units of debt. And that number or the units of debt are multiplied with the market price of debt to arrive at the value of debt of the redeemable traded bonds. So we will see all these calculations in some time, but I just wanted to give you these calculations first. So how to find the values of equity and debt, assuming that a business is using ordinary share capital, preferred share capital, bank loan, and redeemable traded debt. What we simply do is find the VE, find the VP, then the VD for bank loan, and the VD of redeemable traded bonds. Now, the VD of the convertibles and the VD of the irredeemable debt follows the exact same calculation which is here for the VD of redeemable traded bonds. So in some other questions which I have put on that list of questions, you will see you are going to work things out exactly same way how I will work out the VD of the redeemable traded bonds today. Now, this is the values part. So if I go back to that extended WACC formula, at this point, we are okay with all these. We should be fine with working out all these values. VD of the loan, VD of the redeemable debt, we're okay with all these values. And the only thing now which is left is how to figure out the costs of all these sources of finance. So we need to look at ways in which we can find the KE, the KP, and the KD1 minus T of the loan and the redeemable debt. So before I jump into the costs, can I take any questions at this point? So if you got any questions on things which I have just covered now, which is thinking about sources and their values. So if you got any quick questions at this point, I'm happy to answer before I jump into the costs. So any quick questions up to this point, please feel free to drop them in the questions box. Okay, so it's looking all okay for now. And now, oops, a quick question coming in. The question here is, where is the WACC used in valuation? As I said, we are not covering valuation today, so that's session 4. The next question is, can you go over the bank loan? Yes, can go with the bank loan. So within the bank loan, to find its value, what we simply do is we take the long-term debt from the SOFP. So the bank loan will be shown in the long-term liabilities. We'll take that book value, and that book value is also the market value of the bank loan, because bank loans are non-traded. So their historic values are also their market values. There's no difference in historic and market value for a bank loan. So we'll simply take the non-current liabilities bank loan. So we'll see that in a question shortly as well. Okay, the next question here is asking, what is SOFP? Well, SOFP is the statement of financial position of the balance sheet. Okay, so let's move on this point into the costs, because we need to finish this topic and then go into a question. So the costs of equity and debt. Again, these revision webinars, you will have links where you can watch them again. So there's no point in going over same things over and over again when you can watch it, basically. So once you get the links where you can watch them again, so feel free to watch it as many times, and then it will consolidate when you're revising for the exam. So within the costs, the first thing is to think about the KE. KE. KE is the cost of equity, or the return required by equity providers. And in our syllabus, there are two ways in which cost of equity can be computed. The first way is rearranging the growth model. The first way is rearranging the growth model. And the second way is capital asset pricing model. So two ways in which we can compute the cost of equity. We can compute it using a rearrangement of the growth model, and we can also compute it using the CAPM model. Now, what we can do is we can go over them one by one and see both ways. A common question at this point students ask is, well, how would I know if I have to use rearranging the growth model or I have to use the CAPM? Well, the answer to that is that it purely depends on the information given in the question. If the information is such that you can use the rearranging of the growth model, then use that. If the question gives you information about CAPM, then you have to use that. The examining team may not necessarily tell you which one to use. So when we say rearranging the growth model, on your formula sheet, you've got a growth model calculation, which is P naught, D naught, 1 plus the G, RE minus the G. So this is the calculation you have in the growth model. Now, what we have here is we have got few things. This is the share price, this is the dividends, this is the growth rate, and this is the return on equity. Share price now, dividends now, return on equity, and the growth. So there are 4 things here in this growth model calculation. Now, what we need to see here is we need to think of this RE. This RE, return on equity, is from the investor's perspective. But I can also say that it is the cost of equity, which is from the business's perspective, which is the cost on equity or the cost for equity, cost for debt or cost on equity. So RE and KE are exactly the same things. If you look at from the investor's perspective, it's a return. If you look at from the business's perspective, it's a cost. The investor will get a return for providing finance, and the business will incur the cost for raising finance. Now, imagine that if I have to find this KE within this growth model, I'm going to rearrange this growth model. Therefore, we'll say that the KE is D naught 1 plus the G, P naught plus the G. So this is called the rearrangement of the growth model. Now remember, growth model is given to you in the exam, but this formula here, which is the rearrangement of the growth model, is not given to you in the exam. This is not given. So you have to rearrange the growth model to find the KE. So that is one way in which we can find the KE. Now, please remember 2 things here, 2 important things. The first thing is that the P naught that you will use here has got to be ex-div, and not cum-div. Ex-div means that it is without the impact of dividends. Without the impact of dividends. Because if the share price is cum-div, then it includes the impact of dividends and it is artificially raised share price. We don't want that share price. So for our calculations here, we're always looking at ex-div share price, which is without the impact of dividends. So if I will see a cum-div share price being a question, I will show you how to make it ex-div. The second thing that you need to be careful with is growth. Because when we think of the growth, we think of 2 ways. So for the growth, we look at 2 ways in which we can work out the growth. The first way here is the historic model. The second way here is the Gordon's model. The historic model is G equal to D naught over Dn to the power of 1 by n minus the 1. So D naught over Dn to the power of 1 by n minus the 1. And then you have the Gordon's model, which is the G is equal to BRE. Again, questions come from the students at this point. Well, how would we know if we have to use historic model or the Gordon's model? Well, the answer to that is, again, that it depends on the given information. If the examining team has given you information for using historic model, then you have to use it. If the examining team has given you information about the Gordon's model, then you have to use that. So let's just think about these now. What is D naught? What is Dn? What is n? And then what is B? What is RE? So D naught is dividend now. And Dn is past dividend, or the dividend number of years ago. N is number of years. So if I'm using a dividend 3 years ago, then N is obviously 3. If I'm using past dividend of 4 years ago, then N is 4. So that is the historic model. Then in the Gordon's model, B here is the profit retention ratio. Profit retention ratio. And RE is simply the return on equity ratio. Return on equity, which is usually given to us. Within the Gordon's model, the students usually find profit retention ratio to be more challenging. They find it difficult to find the profit retention ratio. So I'm just going to quickly tell you more about the profit retention ratio. Profit retention ratio. Now, to think of the profit retention ratio, we need to have a little understanding here of our P&L or the income statement. So I'll just put a little extract here where we take the sales minus the costs and we get our profit before interest and tax, or our operating profit. Can you tell me by dropping a comment in the questions box here that what is the thing which I have to deduct now when I'm constructing a P&L? So when I'm constructing a P&L, what is that thing which I need to deduct now? So what is the thing which I need to deduct now? Okay, so interest and tax, yes. Not just the tax, but interest and the tax. Well done. So the first thing is we need to deduct the interest. This will give me the profit before tax. And the reason we have deducted interest is because interest is a tax allowable expense. Once I get the PBT, we deduct the tax and we get our profit after tax. Now this profit after tax, another name for that is earnings. This is also our earnings. Now once I've got the profit after tax, this profit after tax has got two parts. The first part is paid out as dividends, and then the remainder part is retained earnings. And if I put simple numbers here and I say that this is $10 as profit after tax, dividends are $3, retained earnings are $7, which means that the profit which I have retained is $7. Therefore, 7 over 10, my profit retention ratio here is 70%. So this is what is the profit retention ratio. So this is how we see the profit retention ratio. I hope that was useful because sometimes this causes a big confusion. Oh, what is a profit retention ratio? So remember, profit after tax is split into two parts, dividends and retained earnings. The part which is retained earnings is basically the retention. And we need to find a ratio, so we take $7 divided by $10, we take 70% as the ratio, the profit retention ratio. So, going back. So, growth, two ways, historic model and Gordon's model. In a question which we'll do just now, we will see one of them. So let's do a quick recap here of where we are. We're trying to find out ways of KE. The way is to rearrange the growth model. Rearranging growth model, the formula looks like this. You have to be careful that you're using share price XDiv, and remember, growth can be computed in two ways, historic and the Gordon's model. Now, the other way of working out the cost of equity is to use the CAPM. And CAPM says that KE is equal to RF plus RM minus RF into beta equity. So this is the CAPM equation which is given to you in your formula sheet as well. A really small calculation. Let's look at things here. So RF is the risk-free rate or the Goodman's rate. RM is the average return in the market. And the beta equity is here, the beta equity. So, I mean, the calculation is not difficult. It's a very, very straightforward calculation here that we have got on our hands. But I would just like to briefly touch about the idea of risk. I would like to touch on the idea of risk and explain that what is the concept of beta equity here. So we'll just go quickly over that and then into the KDs. Just a quick overview of this, of the risk. Remember, the total risk is made up of systematic and unsystematic. So systematic and unsystematic. Now, we usually do not worry about unsystematic risk because unsystematic risk is diversifiable. So we are telling to the shareholders that because it is an easier risk to diversify away, then we are not worrying about that. And so we assume that shareholders can do it themselves. And what we worry about is a systematic risk, which is the market risk. Now, when we think of the systematic risk, there are two important things which we need to know. One is business risk, and the other is financial risk. Business risk is resulting from operations, and financial risk is resulting from gearing. So when you take on debt, your gearing increases and therefore your financial risk. Now, this risk here is industry specific and this is company specific. Can you tell me by leaving comments in the question box that which of these two risks can be zero? Which of these two risks can be a zero? Is it the business risk which can be zero, or is it the financial risk which can be zero? So waiting for your answers here. Which of these can be zero? Is it the business risk or the financial risk? Well, a lot of you are giving the right answer here. Thanks. This is the finance risk because I just said now it is company specific. This can be zero. So if you don't take on any debt, your risk is zero. But this can not be zero because it is industry specific and each industry will have some sort of business risk. Now, the question is, what is beta then? Well, beta is the measure of systematic risk. Beta is the measure of systematic risk. Beta is the measure of systematic risk. And when I think of systematic risk, I think of business and the financial risk. Two types of betas we need to look at. One is beta asset, and the other is beta equity. That's how we show them. So beta is the measure of systematic risk. Systematic risk is thinking about business and the financial risk. Now, as you said that no business can skip or go away from the business risk. So beta asset has got business risk in it. Beta equity has got the same business risk, which is here, but an additional financial risk onto it. So please remember that beta asset has got one risk, beta equity has got two risks. And remember, financial risk can be a zero. If the financial risk is zero, both of them are the same because they've got the same business risk in them. But if financial risk is not zero, then please remember that the beta equity will always be greater than beta asset. And why beta equity will always be greater? Because beta equity has got two risks and beta asset has got one risk. But if there is no financial risk, they can be equal. So when you will do your calculations on betas at some point, please do a reasonably check. Is the beta equity bigger than beta asset? If yes, you're on the right track because beta equity has got two risks. Beta asset has got one risk. Okay, so now that you understand what is beta equity, and now you understand what is CAPM. So CAPM is simply RF plus RM minus RF into the beta equity. So the calculation was really, really simple. So we are going to see in some time the use of one of these models to find the KE. Now, next thing, let's just quickly wrap this up before we can go into a question. We need to find the cost of preference shares as well. Cost of preference shares, which is the KP. So cost which a business pays for raising preferred capital. This is really, really simple because KP is the fixed dividend over the market price of the preferred share. Market price of preferred share. And that's it, nothing else. A very, very simple calculation. Fixed dividend over market price of the preferred share. That's it. Then cost of debt. And we are talking about the bank loan. And we have to find the D1 minus the T. And this is also extremely simple because the KD1 minus the T of the bank loan. So 1 minus T means tax. So T is the tax. KD1 minus T. Why tax? Because interest is a tax allowable expense. So the KD1 minus T of the bank loan is simply your interest 1 minus the T. That's it. Nothing difficult. Extremely easy. So cost of debt of the bank loan is found out by taking the interest in dollar terms and then 1 minus the T. And that gives you the KD1 minus the T. KD1 minus T. Okay. Now, the last thing here is the cost of debt of redeemable bonds, redeemable traded bonds. And we are going to work out the KD1 minus the T. Now, the approach we used here, is IRR. And I'm sure you know that from your tuition phases that we use IRR approach to find the KD1 minus the T of the redeemable bonds. There is a little structure that we will use. We'll take the year, cash flows. I use 5 and 10%. Discount factor, present value. Discount factor, present value. Remember in the IRR approach, we take 2 percentages and we find the present values of the cash flows on those 2 percentages. So I like to use 5 and 10%. It gives you the right answer each time. In the exam, you're free to use any 2 percentages really. It doesn't matter much, but just to keep a standard, I'll use 5 and 10%. In terms of the cash flows or the items which will come here, we'll have the market price. We'll have the interest 1 minus the T. And we will have the redemption value. So market price, interest 1 minus T, and the redemption value. We'll put the years. So this will be T0 on now. And these both will be in the future. We'll put the cash flows in, we'll discount them, and we'll find their present values. And once we have found the present values, then KD1 minus the T is the low rate plus present value at the low rate, present value of low rate, present value at the higher rate into high minus the low, the IRR approach. And that is it. This gives us the KD1 minus the T. Now, I may talk about this idea that why the IRR approach. So if I have time, I will talk about it, why IRR approach. But here, the aim for my discussion here is to get through the numbers quickly. And once I have the numbers, and if time permits, I will go into the idea why we're using the IRR approach. Now, that's it. So we've got everything ready for our question. And I'm just going to do a little recap of things here so that we are starting on the right track together. So these are all the sources of finance which can be there in your exam. I'm going to do a question which is going to use the first 4 sources of finance: the ordinary share capital, preferred capital, bank loan, and redeemable traded debt. Which means for these sources of finance, I need to work out their values and the costs. Once I'll work out their values and the costs, which we now know, so we know how to find out these costs as well, I will be using this WACC formula. This is the extended WACC formula, which will be used when there are two more sources of finance, when there are two or more sources of finance, we use this formula. Now, the values of equity and debt is a simple calculation. We have seen number of shares into the market price, number of shares into the market price. The VD of the bank loan is also easy because we simply take the historic cost from the SOFP. The VD of the redeemable bonds is to take the book value over the par, which is 100, into the market price of debt. When we think of the cost of equity, there are two ways in which we can do it. One is rearranging the growth model. The other is CAPM. Within rearranging of the growth model, this growth model calculation is given to you in the exam. But the rearrangement of that is what we need to do. So to find the KE here, so to find this KE, this is how we rearrange this formula. And then we'll simply input the values in to find the KE. There are two issues here. The one issue is that you could be having an issue where you would be expected to use ex-div share price, which is without the impact of dividends. And you should know how to work out growth. There are two ways in which to work out growth, historic and the Gordon's model. When we think of Gordon's model, the problem area sometimes for the students is the concept of B, which is the profit retention ratio. And again, I showed you how to work that ratio out. In terms of CAPM, it is very simple. It is RF plus the RM minus RF into the beta equity. Now that gives us the cost of equity calculation. Then I just briefly touched onto the risk part as well, which is important. The total risk is systematic, unsystematic. We don't worry about unsystematic because that can be diversified away. Within systematic, we look at business and financial risk. Financial risk can be zero. Business risk cannot be zero. Beta is the measure of systematic risk. Two types of betas, beta asset and equity. Beta asset has one risk, beta equity has two risks, which means that beta equity will always be greater than or equal to beta asset. These will be equal when there is no financial risk. We thought of cost of preference shares, easy calculation, fixed dividend over the market price, and then the cost of debt of the bank loan, which is interest 1 minus the T. Now, the cost of debt of the redeemable bonds, we need to use the Irr approach. This is the structure we're going to use. We're going to lay down the structure, discount these at 5 and 10%, and then put them into the IRR formula to find the KD 1 minus the T of the redeemable bonds. Now, any quick questions here before we move into the questions? Any quick questions here? So remember, you can always watch these videos again. So I hope that I don't have to repeat any things in detail. But if any conceptual questions, I'm happy to answer at this point. But if I have already talked about something, I may not do that again because you can always watch the video again. So the question here is that which method is better, CAPM or rearranging growth model calculate KE? Well, both methods have got their pros and cons. But in the scenario, you will be given information about one. So whatever information is available, you'll be using that to compute the KE. But both of them have got their pros and cons. So there's no right or wrong. But CAPM is the one which is more frequently used, let's say. The last question here is to talk briefly about the beta. Again, so beta is the measure of systematic risk. There are two types of betas, beta asset and beta equity. Beta asset has just got business risk, and beta equity has got business and the financial risk. Because systematic risk is business and financial risk. Remember, financial risk can be zero. Business risk cannot be zero, which means beta equity will always be greater than or equal to the beta asset. So let's move into a question now. Can I take you to AMH question from June 13 exam? So I've taken this question from a few years ago, which I think is a really good question to practice for the upcoming exams because it uses 4 sources of finance. The AMH question, June 13 for 25 marks. Now, you have this question already with you as part of the documents attached to this webinar. We won't have the CBE version of this exam, so we'll have to rely on this copy of this question, which is the June 13 exam. So I'm going to read the question from here, and then I will solve it on the extra constructed response questions. Now, let's read part A here. Part A is to calculate the market value WACC for 12 marks. Market value WACC for 12 marks. Straightforward calculation of the WACC here. We will come back to B and C later, but let's just focus on A. So let's read this question carefully. So again, I would appreciate if you keep making notes of important points here. So AMH wishes to calculate its current cost of capital for use as a discount rate in investment appraisal. So we already know that WACC is used as a discount rate in investment appraisal. The following information relates to AMH. We have got their financial position statement extract, and this financial position statement extract is the balance sheet. It is SOFP, Statement of Financial Position. What I see here is that they have got equity and the debt, and equity has got ordinary shares. Then within the long-term liabilities, I also have 4% preference shares, which has got again, which is basically a form of equity. But the reason it is being shown differently here is because it has got some features of debt, like the fixed income, which the providers can get. So 4% preference shares. Then we have 7% bonds redeemable after 6 years, and we have a long-term bank loan. So as you're reading this, you would be thinking, ordinary shares, I need the VE and the KE. Preferred shares, I need the VP and the KP. 7% bonds, I need the VD and the KD1 minus the T. And the long-term bank loan, I need the VD and KD1 minus T. I need all these calculations here for my WACC. Now, all the values are here, but remember, all these values are the book values, and I'm looking for the market values. So we need to do market value calculations on all these sources of finance. So there are 4 sources of finance: 1, 2, 3, 4. So the WACC formula will now be extended. Then it says that the ordinary shares of AMH have an ex-div market value of 470 per share. So this is the market price of the ordinary shares. So market price of the ordinary shares is 4.7. So once I have the number of shares, I simply multiply that with market price to find the VE. And an ordinary dividend of 36.3 cents has just been paid. So this seems to be the D0. Historic dividend payments have been made as follows. Well, why is the examining team giving me details of historic dividends? Because they want us to work out the G via the historic model. G via the historic model. So if this is the dividend now, which is 2012, and the historic dividend is 2011, 2010, 2009, 2008. Then I'm going to use that historic model calculation to work out the G. So we'll do that together. The preference shares of AMH are not redeemable and have an ex-div market value of 40 cents per share. This simply means that this is the market price of preferred shares. So what I'll do is I'll find the number of shares into this market price to find their VP. The 7% bonds are redeemable at a 5% premium to their nominal value of 100 and have an ex-int market price of 104.50. Now there are some key words here we need to pick. First of all, what is this 7%? This 7% is the interest or the coupon. And remember, interest of the coupon is always applied on the par value, which on our paper is always $100 for the debt. They are redeemable at 5% premium to their nominal value, which is $100. So that means the redemption value is $100 into 1.05. which is $105. So they are redeemable at 105. 5% premium to their nominal value. So we'll just add that 5% onto the nominal value, which we know is always 100. And have an X int market value of 104.50. What is this? This is the market price of this debt. This is the market price of the debt. Traded debt, so it has a market price. The bank loan has a variable interest rate which has averaged 4% per year in recent years. This is the interest of the bank loan. And what I'm going to do is I'm going to do 1 minus the t to find the KD 1 minus the t. Tax is at 30%. So simply tax is at 30%, where we will use it in some of our calculations. Now, this is all the information available. I'll just stop here for a few seconds and I will be receiving questions at this point. So can I get some questions here on the given information in this scenario? So any quick questions here before we go into the workings on this particular question? The questions are coming in. The question here is that what will we do with the 4%? Well, the 4% is the interest on the bank loan. And the interest on the bank loan, we will do 1 minus t, and that will give us the KD 1 minus the t. So what I want you to do now is go back to the PDF which I created and look at the ways in which I have thought about creating the concept of VE, growth, and the Ks and the KPs and the KDs. So this is all the information which we will need to absorb and bring now, because I'm just going to slot in the numbers in these calculations and find the values out. Next question here is, why do we do 1 minus the t? Because interest is a tax allowable expense. So when we incur interest cost, we save some tax, and therefore the interest liability then reduces. Any more questions here on this part? Difference between CUM and XDIV. CUM div is including the impact of dividend, which is artificially raised share price, and the XDIV is without the impact of dividends. For our calculations, we always use the XDIV market price because it's more of a stable share price. The next question is, don't we take short-term loans in the WACC calculation? No, we do not take short-term loans. We only think of the long-term sources of finance. Okay, so can I now ask you to please go into this question again, the AMH question, and I'm going to solve this question by using the constructed response workspace, so you get the same experience of the exam. You can also open the constructed response workspace, which is available on the CB exam link, the specimen exam link, where we have the constructed response workspace. And because it is the 2013 question, therefore we don't have the CB version of it as yet. Okay, so what I need first from this question here is I need to sort out the values part. I need to get rid of my values calculations, which are easier. So the first thing is we need to look at ways in which we can compute the VE, the VP, the VD of the bonds, and the VD of the bank loan. So I'll take you back to this PDF which I created. So how can we find out the values of equity? VE is the ordinary share capital in dollar terms over the par value of the shares into the market price per share. So what is the ordinary share capital here? Well, the ordinary share capital is $4 million. What is the par value of these shares? 50 cents. And what is the market price of the shares? That was the 4.70. So $4 million is the share capital in dollar terms. Par value is 50 cents. And then the market price is 4.70. So what we can now do is we can do the calculation here. We can do the calculation here where we are going to look at the value. So AMH question, part A, looking at the WACC. So first of all, value of equity. So 4 million, 3, 4, 5, 6. Par value is 0.5 and the market price here is 4.70. So this has given me the value of equity. So share capital in dollar terms over the par value into the market price per share. And that has given me the value of equity, which is $37 million. So all workings are in dollars. So 37,600. Next thing is the value of the preferred share. And again, it was easy because VP is the share capital in dollar terms over the par value of the preferred share and into the market price of the preferred share. So let's go and take that from the question. Here it said that the share capital of the preferred capital is $3 million. Their par value is $1. The par value is $1. And remember, the market price of these is 40 cents here. 40 cents per share is the market price of preferred share. So what I'll do is I'll take the VP, 3 million, dividing my $1 into the 40 cents, which is the market price of the preferred stock. So 3 million is the share capital, 1 is the par value given in the question, and 0.4 is the market price of the preferred stock. And this has given me now my value of the preferred stock, which is $1.2 million. Next, we have to think of the VDs. Now, the VD of the bank loan is easy because the long-term bank loan in the SOFP, the book value is $1 million. And as I said, this $1 million is also its market value because it is non-traded. So the VD of the loan, we are just going to say that this is the $1 million. So the VD of the bank loan is equal to its historic value. Finally, the VD of the bonds, the redeemable debt, VD of the redeemable debt. And again, go back to this set of notes. How do we find the VD of redeemable debt? Well, that is book value over 100 into market price. Book value over 100 into market price of debt. So let's take the book value. The book value is given here nice and straight, which is $3 million. So the book value here is given as $3 million. Par value is 100. And the market price of the redeemable debt given in the question is here, which is 104.5. So the market price is 104.5. So I'll take the 3 million, which is the book value, over the par value 100 into the market price 104.5. 104.5. So book value over the par value into the market price 104.5. That gives me the value of debt of the redeemable bonds. Now that is it. I've got all my values out. And if I tell you about the marks available here, there were 0.5 marks available on each of these calculations on this exam. So far, we have now collected 2 marks here. So we collected 2 marks here on this calculation. Okay, so we're done with all the values now. I'm open to taking any questions at this point quickly. So if you've got any questions, please feel free to put them here. If you've got questions on working out these values. And again, I've done nothing differently here. I've just taken the ways in which I'll compute the values from the PDF which I created, and then I simply slot in the values. So any quick questions here? Oh, the question is coming in. The question here is, for the redeemable debt, is par always 100? Yes, it is always 100. In some situations where they say that the debt will be redeemed at a premium of 5%, that means we're talking about redemption value, not the par value. The par value is always $100. The redemption value can be 100 or anything more than 100, depending on the given instructions in the question. Okay, all good. Let's go into the next part. Now, what I need you to do is I need you to focus on the cost part. So first of all, we are working out the cost of equity. Now, can you tell me here that in this question, was the information available to compute the cost of equity using the rearrangement of the growth model or the capital asset pricing model? So you tell me that what information is available here. Do we have information about rearrangement of the growth model, or do we have information about CAPM? Yes, rearrangement. Well done. Well done. Yeah, we have the information about the historic model for growth and the rearrangement of the growth model. We have no information here about CAPM. So I can't use CAPM. So I have to focus on rearranging the growth model. And what I need you to focus on is now this calculation. I want you to focus on this calculation here because you are going to find the KE. And you're going to find the KE using this calculation. So for that, we need 3 things. We need the dividends, we need the growth, we need the share price. So let's go into this working now. KE via rearrangement of the growth model. So KE via rearrangement of the growth model. We need 3 things here. We need the dividends now. We need the share price, which has to be ex-div, and we need the growth. Now, dividend now was given nice and straight in this question. So if I go back to the question, the dividend here was, the dividend now was 36.3 cents. So 36.3 was the dividend now, so that's the 36.3. The share price ex-div was also given nice and straight, the 4.7, which was ex-div. So ex-div market price of the ordinary shares, 4.7. And the only thing now I have to work out is the growth, which is the growth model, and that is the historic growth model. So I want you to focus on this calculation now, the historic model calculation. So we have the D naught. The D naught is given in the question as 36.3. So 36.3 D naught. Now I need to find out in this question what is DN. DN is the past dividend. So if 2012 is 36.3, the 2008 dividend, the past dividend, the first point of the dividends was 30.9. So I'll take this as DN, the 30.9. 30.9 to the par to the power of 1 by n, of 1 by n. Now I want you to see this point. If I am using 2012 dividend as D0 and the Dn is 2008, then what are the years differential between these 2 points? Well, from 2012 to 2011 is 1 year. So 2012 to 2011 is 1 year. Then to 2010 is 2 years. Then to 2009 is 3 years. And then to 2008 is 4 years. So it's 1 by the 4. It's 1 by the 4. Close the bracket and then minus the 1. So D0 over Dn to the power of 1 by 4 minus the 1. And we get our growth. And we'll show this growth in a percentage form, and which is 4.11%. 4.11%. Now, once we've got the 4.11% growth, I'm going to use rearrangement of growth model calculation to find the KE, and that will be the D0, which is B15, into okay, you can just put the dividends as 0.363 because we are working the share price in dollar terms. So the dividends have also got to be in dollar terms, 0.363. So the KE is B15 into 1 plus the G, which is the B17, over the B0, which is the B16, plus the G, which is the B17. So D0, 1 plus the G, over B0, which is B16, plus the G, which is B17. So what I've done here is I have simply used this formula on my spreadsheet. The rearrangement formula is what I have used on my spreadsheet just now. Nothing else. The rearrangement formula of the growth model is what I have used. Understand? Yeah, this formula here is what I've used here. Now, once we'll do this one, and we can show the KE in a percentage, we get 12.15% as the KE. Now, at this point, I have secured 3 marks. There is 1 mark here for working out the growth, and there are 2 marks here for working out the KE. So 3 marks on the KE calculation. Now, can I have questions quickly on the KE before we move into the other things? So questions on the KE here. So the question is, are we working in dollars or cents? Well, it has to be like to like. As I saw, the share price was in dollars, so I converted my dividends also in dollars. Why did we minus the 1? Because that is the growth model calculation. That's how we find the historic growth. So it's a cumulative function, then we deduct the 1 from it. Is the rearrangement formula also called the dividend growth model? Well, growth model is to find the P0. So this is a rearrangement of the growth model, which we use to find the KE. Number of years in the dividend growth, well, that is 4, because you'll be using the 2012 dividend as current, and the earliest, the previous dividend was 2008. So from 12 to 11 is 1, from 11 to 10 is 2, from 10 to 9 is 3, and from 9 to 8 is 4. The next question is, if we have cum div price instead of ex div, how do we find ex div? You simply deduct the current dividend. So if you have cum div share price, simply deduct the current dividend. Why we add G in P0? Well, the reason you add G in P0 is because this is the rearrangement formula. And when you rearrange this, mathematically, you have to add the G here, then to find the KE from the formula, which is here. So we rearrange that formula. Okay, final set of questions. Will we get the same answer if we use 2009 instead of 2008? No, we will not get the same answer. because you have to use 2 points in time, one being the current dividend and one being the first set of information of the dividends given, the 2008. Okay, so that's all the questions up to this point. Next thing, we need to work out the other costs. The other costs are the KP, the KD of the bank loan, and the KD of redeemable debt. So again, I want to move back to this here and look at ways in which we are going to compute the cost of preference share and the cost of the bank loans. So the cost of preference shares is simple, fixed div over the market price of preference shares. Let's get that out of the way. So KP is fixed div into the market price of preferred shares. So what is the fixed dividend here? Well, the fixed dividend here is basically the 4%. So 4% on a nominal value of $1. 4% on nominal value of $1. And remember, the market price of these preferred shares was 40 cents. 40 cents. So 4% on $1 and then 40 cents. So 4% on $1 over market price, which is 40 cents. And this will simply give me the KP, which is fixed dividend over the market price, KP. And this will come out to be 10%. And this 10% will give me another mark here. So 1 mark for it. So that's it on the KP. The bank loans are also extremely easy. And when we think of the bank loans, we simply take interest 1 minus the tax. The interest on the bank loans here was given as 4%. 4% was the interest on the bank loans. And the tax rate, remember, was 30%. So 4%, KD 1 minus the T. We're working on the loans. So the interest here is 4%. So 4% is the interest, and then into the 1 minus the T. So 4%, 1 minus the T. This will give me, 4 into 1 minus the tax. So my KD of the bank loan is 2.8, the 2.8%. The 2.8% is the KD of my bank loan. And this will also give me here the 1 mark. So 1 mark here for working out the KD of the bank loan. Now we have got here all the costs. The only cost here left is the KD 1 minus the T of the redeemable bonds. Redeemable bonds or the debt. Now we will need to go back to this calculation where we're going to work out the structure. So I want all focus now to go on the structure where we're going to put 3 things: market price, interest, and the redemption value. So let's think about this. I'm going to use the structure, which is here. Cash flows, 5%, 10%. The cash flows would be the market price. Interest, 1 minus the tax, and the redemption value. Now, the market price of this redeemable debt given on the question, market price of the debt given on the question was 104.5. So we'll show this 104.5 and we show it as a negative, being the market price in today's time. The interest on this redeemable debt is 7%. So 7% is the interest. Remember that the interest has to be taken as 1 minus the T. So 7 into 1 minus the tax, which is 30%. We get 4.9. And remember, the redemption value here was 105. Redemption value in this question was 105. 5% premium to the nominal value. So 105. And what we need to do now is to discount them. So this is T0. How many years is the interest? Well, the interest is for 6 years given in the question. So from T1 to T6. and finally the redemption value in T6. So let's put the discount factors in. Let's put the discount factors in here and discount these to find their present values. So I'm going to put the discount factors in. I'm just going to use this above. Discount factors, present value. Discount factors, present value. So can I just ask you all while I'm doing it to also put in your discount factors and find the present values out of these here, so that when we can discount and find the present values. So I'll need the tables. So let me work out the tables. So here are the tables. We're looking for the 5% annuity for 6 years. 5% annuity for the 6 years, which is 5.076. Looking for 10% annuity for 6 years, which is at 4.355. 355. Then going into the PV table, 5% for the 6th year, which is 0.746. And the 10% for the 6th year, which is 0.564. So we'll find the present values, which is the C30 into the D30. C30 into the D30. We'll drag this down. And then C30 into the F30. We'll drag this down and take the sum from E30 to E32. Copy this here. And then use the IRR formula to find the KD1 minus the T, which is the lower rate, which is given in D28, plus the present value at the low rate, which is E33, dividing that with E33 minus the present value at high rate, which is G33, into high minus the low, which is F28 minus the D28. F28 and D28. So this is the IRR formula. Once I input all the functions in, I'll get the KD1 minus the T here, which comes out to be 4.71% or 5% rounded. And this will give me 3 marks here. 3 marks for working this out. So we have found out now the cost of equity, the cost of preferred shares, the cost of the bank loans, and now we have also found out the cost of the debt of the redeemable bonds. So I'll just stop here for some quick questions. Can I have some quick questions here now? So let's look at the questions. Okay, so there are quite many questions here. The first question is, how did you know it is 2012? Because it said in the question that the statement of financial position is for the year ended 2012. The next question is, why don't we do 4% on the 3 million instead of $1? Well, I didn't take $1. The 4% I think is on par value of 100. It's up to you if you like to do it in total terms. I'm working on per unit of debt, which is easier for the students to do in the exam rather than working total terms, but no problems if you want to do it in total terms. The next question is, how do you get the interest of the bank loan by getting the interest into the book value? Interest on the bank loan by getting the interest into the book value. Well, we haven't done that. We've taken the interest into 1 minus the T, and it is a percentage. Why is the market value negative? Because in the IRR calculation, the examining team likes to show market value as negative, but if you don't like to show market value as negative, you can show it as positive, and show the interest and redemption value is negative, and you'll get the exact same answer. So it's not a big deal with that. Could you show us the IRR function? Well, we can't use the IRR function here because this is not investment appraisal. This is a structure for finding the bonds cost. Then can we? You can't use the function here. Function can be used in investment appraisal, but not when working out the cost of the bonds. You have to show 5%, 10%, and then use the formula here because the marks are for the steps involved here. Is market value always considered in DVM? Well, the market price of share is always used in that rearrangement of growth model. And the final question here is, can you go over C31? The C31 is here. Yeah. So that is the interest, which is $7 into the 1 minus the tax. So I hope these are all questions answered at this point. And what we have got now is all the costs that we have computed. So let's just look at this. We've got all the values in value of equity, value of preferred stock, value of debt, and value of debt for the bank loans and redeemable debt. And then we have here the cost of equity, which was 12.15, cost of preferred shares 10, KD1 minus T of the bank loans 2.8%. Let me just show this as a percentage. So 4% into 100 into 1 minus the T. So 2.8% is what we are looking at here. 2.8%. Or 3% rounded. And then finally the KD of the bonds, which is 4.71. Now this area is not easy because usually the students would have seen questions which focus only on 2 sources of finance. Now because there are more sources of finance here, so obviously there will be more questions. So I'm still happy to take any questions at this point. And then we'll move on from here into the final WACC calculation. The next question is there any problem to use twice negative values for IRR? There is no problem in that. So as I've got here the values of 5 and 10% as negative, and as I use this formula, there is no problem in using 2 negatives. This is also a problem sometimes in the exam. Students try to use 1 positive, 1 negative, and in pursuit of that, they waste a lot of time, which is not needed. The last question here is, can you simply put the interest into the 1 minus T? Yes, you can put, and you will get the same KD 1 minus T of the bank loan. Now, for the final part here on the WACC, what I always advise is that you break this calculation down. So you break this calculation down into ordinary shares, preferred shares, bank loan, redeemable debt. So just for simplicity reasons, I would break down this calculation and show to the examining team the 4 different sources of finance. So what I'm planning to do here is use this big WACC formula. So planning to use this big WACC formula, but instead of doing all that in one function, I'm going to do it in 4 steps. In step 1, where we'll do this. In step 2, where we'll do this. Then step 3 here. And then finally the step 4. So we're going to break this calculation down into 4 steps. So the first one is VE over all the values into the KE. So let's go and do it. So let's take our VE, which is in B5, over B5, B7, B9, and B11. So B5 over B5, B7, B9, B11. So I've got all my values in now, and I will multiply these values with the cost of equity that I have, which is in B19. Cost of equity in B19. So cost of equity in B19. And this will give me the cost of using the preferred capital. So, sorry, the cost of using the ordinary share capital, which is 10.64. So value of equity divided by value of equity plus value of preferred stock, value of debt into the cost of equity. We'll do the same thing for the preferred share. So I'll take the values now again, which is in B7. So B7 divided by B5 plus B7 plus B9 plus B11 into the cost of preferred shares. And the cost of preferred shares is B21. So this is done. Bank loan now, which was B9 divided by B5, B9 divided by B5 plus B7 plus B9 plus B11 into the cost of the debt of the bank loan, which is in B23. And that gives me the cost of the bank loan. And finally, the redeemable debt, which is in B11, B5, B7, B9, B11 into the cost of debt. The cost of debt here is the B35, and this will give us our redeemable debt calculation. So B11 over the entire capital into the cost of debt of redeemable debt, B35. So once I've got all these down now, I'm going to add them together and say that A40 plus B40 plus C40 and D40 is our WACC. And this is our final calculation here, giving us a WACC of 11.3%, and there were 2 marks for this. Now, once you're confident with this calculation, I don't have any problems if you'd like to merge some of these parts, but for simplicity reasons, I would break it down into 4 components and then show the calculation separately. So any final quick questions here on the WACC before we move on? So any final questions here on this WACC part? Please feel free to drop your questions now on the WACC calculation. Okay, so the questions are now coming in. Is it okay to write the amount without applying the formula on the cell like you did the Irr calculation? To write the amount without applying the formula on the cell. I don't really get that question. If you can just rephrase it. And again, the next question is, can you reiterate a bit on the WACC calculation? Yes, I'll just go over that again. My answer is 11.05. Yeah, anything close to 11% is okay. Abbreviation or acceptable in exam? Yes, the examining team is fine with that as long as these are reasonable. So the ones which I'm showing you here on my answer are all accepted. Explain the WACC formula once. Well, I've already done that on the PDF. So once you go through the video, I stressed quite a lot when I was expanding that WACC formula. So that should be okay there. Okay, fine. So I will just show you this again. So this is VE over all capital into the cost of equity. This is VP over entire capital into the cost of preferred capital. This is VD of the bank loans over the entire capital into the cost of the bank loan. And then this is the redeemable debt, VD, over the entire capital into the cost of debt. So we have done this finally, the 12 marks. Extremely complex and long working here, but this is a really good question to practice. What I'm going to do here is I'm going to take a quick break of a few minutes, but just 2 to 3 minutes. And within these 2 to 3 minutes, I'm still happy to take more questions. So if you got any questions, please write the question in the question box. Once I come back after 2 to 3 minutes, I'll quickly answer them, and then we'll move into the next part. So just 2 to 3 minutes of break, and please feel free to drop your questions within this time. Okay, so we have got just a couple of things here. The question is, for calculating the market value of company, future cash flows over WACC, should we use the before tax WACC or after tax WACC? Well, again, this is primarily a valuations question, but if you are using future cash flows to the company, then you're using an after tax WACC there. So I will go with this on the valuations part, which is session 4. The next comment is, it will be easy for WACC calculation if all V's are summed up in a cell. Yes, I agree with that. I don't have any problem if you like to do that. But I just wanted to show here that what I wrote on the PDF is what I'm doing here. That is taking the value over the entire capital structure and then into its cost. So this was an extremely good question, AMH, with 4 sources of finance. Let's look at the other bits here on this question. There is a bit of discussion required here on this question. Let's read that. Part B says, discuss how the capital asset pricing model can be used to calculate a project-specific cost of capital for AMH, referring in your discussion to the key concept of systematic risk, business risk, and financial risk for 8 marks. Now, we haven't really gone into the topic of project-specific discount rates on this revision webinar, but I will construct an answer to it. And within this answer, I will explain to you what happens when we think of the project-specific cost of capital, so that this area is also covered for you. So let's talk about that. Says how the CAPM can be used to calculate a project-specific cost of capital for AMH. So I'm going to construct an answer on this one. So I'll just need a word sheet here. So for 8 marks, as we did some practice in session 1, we need good enough explanation or discussion to earn these 8 marks. How CAPM can be used to calculate project-specific cost of capital for AMH. Refer in your discussion key concept of systematic risk, business risk, and financial risk. So let me construct an answer. I would like to write 8 points here. So this is B. If AMH decides to go from core to non-core industry, it cannot use its existing WACC and will need a project-specific discount rate to be used to appraise the project. CAPM can be used to find this project specific discount rate, i.e. the KE. And this will be used to discount future cash flows to appraise such projects. Total risk is made up of systematic and unsystematic risk. Unsystematic risk is diversifiable, and it is assumed that shareholders are well diversified. So the focus is on systematic risk, which is market risk. It is further broken down in business and financial risk. Business risk is industry specific and can never be zero, whereas financial risk is company specific and can be zero. Now notice here, I am going to still talk about the project specific discount rates, but because the examining team asked me in this question to focus on systematic risk, business risk, and financial risk, so therefore I am also talking about that. What I have written so far here is worth up to 4 marks. So 4 brief paragraphs, 4 marks. Then, for project specific discount rates, AMH will need to identify a proxy, i.e. a company in non-core industry, and take their beta equity, which has business and financial risk in it. It has business and financial risk in it. AMH will then need to ungear this beta to remove the financial risk and obtain the proxy's business risk only. This will then be re-geared to add AMH's financial risk to proxy's business risk to find a revised beta equity for AMH. This revised beta equity will then be used in CAPM to find the project specific discount rate on which adjustment of business risk has been made, and that is it. So this answer which I have constructed here is worth 8 marks, and this area is my worry area for the students, that can they write enough to earn the marks for discussion. Now my answer is not the same as what would be examiner's answer, because what I have written just now with you is an answer constructed thinking of a student's level of understanding. The mistake which students make sometimes is they go into examiner's answer, try to learn it, and try to copy things from there. But that answer is written by the examining team for guidance. It has a lot of points in it which we may not need. So if you look at the structure of my answer here, what I've got here is about 8 brief paragraphs. 1, 2, 3, 4, 5, 6, 7, 8. And this will give me 8 marks. And I've just explained things in my own words at a student's level of understanding. So I really hope that this exercise of constructing these answers is also useful, because we just can't do it all on the numbers alone. We do need some discussion on this paper. So I hope that this area would be okay. If you got any questions here on project specific discount rates, I'm happy to answer them here. So any quick questions on project specific discount rates? So I'm happy to answer here. Any conceptual questions here on project specific discount rates? Any quick questions on project specific discount rates? The question is, I wish we could have a working on this. Well, do you mean that you want some numbers on this area? Well, there are questions in the past. I will just identify 2 questions for you. One is a question called card, and the other question is called fence. Both questions have got a working on this area, which you can practice for numbers, but due to time constraints on this webinar, I won't have the chance to really go into the detailed calculations there, because we just have 2 hours 30 minutes to cover the pretty much all the business finance. So this seems all good. Good exercise. Last part here on this question is discuss why cost of equity is greater than cost of debt for 5 marks. Now this is a very, very frequent requirement, and the one which causes a lot of trouble in the exam. So discuss why cost of equity is greater than cost of debt. Now, again, I'm going to construct an answer here. Cost of equity is greater than cost of debt because equity is more risky as compared to debt. As the risk is higher, that means the equity providers are looking for higher return. This is a basic finance concept, that higher the risk, higher the return expected by investors. The risk associated with equity is more because the equity providers are ranked after all others on liquidation, which means they may not be able to get their money back. In addition, equity providers do not get fixed income like interest as their return, i.e. dividends, is voluntary and can change based on the performance of the business. Finally, equity providers, being the decision makers, take on more risk in managing the direction of the business. And all this raises the risk attached to equity, which is reflected in higher return. All above points are the reasons why cost of equity is more than the cost of debt. And that's it. So 5 marks, and I have written enough here to secure all the 5 marks on this answer. And again, in my own words, breaking it down using simple language, simple words, and not using any terminology here which is difficult. So I'm happy to take on question now at this point on this the greater risk, greater cost expectation. Yes, you're just right. Higher the risk, higher the return, or higher the expectation. Any more questions? Any questions on this before we move into the next bit? So we are done with AMH, which is the 25 mark question. So any questions here on this before we move into the next bit? We'll just wait for a few questions. We're moving on. Okay, so it seems all good on AMH question. The next thing which I want you to do is to go into a question called KQK, which is September, December 15 exam, which is also within your documents attached to this webinar. KQK question from September, December. Now, within business finance, we can have quite many different types of calculation in the exam. We have just seen the WACC. But this is also a type of question which can come in the exam. And this question is focusing on a bit of ratios, and a bit of P&L extract. So this is a type of question which can also come into the exam, and we should be happy with it. So the remainder part of this webinar, we're going to focus on this question and try and do as much of it as we can. So part A is to assess the impact of financing. Assess the impact of financing. Assess the impact of financing the business expansion by the loan note issue. Assess the impact of financing the business expansion by the loan note issue. So it seems that they are raising some sort of debt. So they're raising some sort of debt here. And they are saying, well, what will be the impact of this financing on the business expansion, on the financial position, financial risk, and shareholders' wealth after 1 year using appropriate measures for 10 marks. Financial risk, shareholders' wealth. So on financial position, financial risk, and shareholders' wealth. Now, just to summarize this requirement, when the examining team wants something on financial position, they may be asking for a P&L extract and something to do with an SOFP extract. So I will see what I can do on this question. So financial position is basically SOFP extract, but to get that SOFP extract, we will need the P&L extract, because the P&L extract will have the retained earnings, and we know that retained earnings would then go into the SOFP extract. The financial risk part is where the examining team is asking me to do a bit of gearing percentage and interest cover. And shareholders' wealth will be something to do with the share price or dividends. So I will have to construct a bit of P&L extract, take the numbers into SOFP extract, and then do a bit of gearing percentage, interest cover, and then something on the dividends as well. So that is all for 10 marks. Let's read this question and then have a try at this. So KQK wants to raise $20 million in order to expand the business. So this is the amount they want to raise, 20 million. The amount. And wishes to evaluate one possibility, which is an issue of 8% loan notes. The 8% loan notes. So that is the debt they are planning to raise, and 8% here is the interest. Extracts from the financial statement of KQK are as follows. So we have their income, we have their cost of sales, profit before interest and tax, interest, tax, and profit after tax. Can you tell me here by commenting in the question box that what is the split of profit after tax? Can you tell me in the question box with a comment that the profit after tax is split into two parts? What are those two parts? We just covered that this evening as well. So what are the two parts in which our profit after tax is split? Dividends and retained earnings. Yes, well done all. Very well done. Yes, very well done. So the profit after tax is split into dividends and retained earnings. Well done. Well done. Yes, good. Okay. Then I have equity finance, ordinary shares, $1 nominal value. So that means 25 is the share capital divided that 1. I have the number of shares as 25 million. We have reserves, non-current liabilities, current liabilities, and total equity. Then, important information. It is expected that investing $20 million in the business will increase the income by 5% over the first year. So the income will increase by 5%. What is the income right now? The income right now is 140. So this will increase by 5%. Okay. Approximately 40% of cost of sales and other expenses are fixed. The remainder of these costs are variable. Fixed costs will not be affected by the business expansion, while variable costs will increase in line with the income. That's interesting. So in the cost of sales here, 40% are fixed and 60% are variable. Now, if the income goes up by 5%, then these here will also go up by 5%. The variable cost of sales will go up by 5%. That's what the question is saying. KQK pays tax at 30%. The company has a policy of paying out 40% of profit after tax as dividends to shareholders and 60% as retained earnings. 60%, the remaining portion as retained earnings, which you already know. Current liabilities are expected to increase by 3% by the end of the first year following the business expansion. So the current liabilities are expected to increase by 3%. Remember, we do have to make a little SOFP extract. And for that, we'll just increase the current liabilities by the 3%. Increase the current liabilities by 3%. Remember, they are planning to raise 20 million debt, which means the non-current liabilities will also increase by $25 million. It's 25. It's 20 million, sorry. $20 million. Increase by $20 million. And then they have given me some average values for other companies similar to KQK. Debt equity ratio. So the examining team is telling me to calculate debt equity ratio based on book value basis. I will do that. They're asking me to do interest cover, which is PBIT over the interest. I will have to do that. I'll have to do a bit of operational gearing, and this is one of the many ways in which operational gearing can be done. But because the examining team has specified that contribution of PBIT, I'll use that. And then return on equity, 15%. I'll have to calculate that as well, which is profit after tax over equity. So the reason all these averages are given for us to use these. Now, if you're short of time, don't do all 4, but at least do 2 to 3 of these within the available time. So this is the scenario. I'm happy to take questions here on the scenario first before going into the workings. So the question is, what if the examining team doesn't tell us that the income is not increasing in line with the sales? Income, well, income and sales are the same thing here. And if there is no increase in the income or the sales, well, we'll just keep the income or sales constant. So we have to follow the things which the examining team wants us to do in the exam. Okay, correction. What if the examining team doesn't tell us that the variable cost is not increasing in line with the sales? Well, in that case, you will not increase the variable cost. That means that the variable cost will be fixed, but that would not make any sense because variable costs go up with the activity. So it's unlikely that the examining team would say that. But if anything is like that, the variable cost has got bigger portion, which is fixed in that, well, just follow the scenario. But it's unlikely that you would have that in. The next question is that, sir, in the question has not told us that 60% is retained earnings. Well, if we know that 40% is dividends, then we know that the remaining 60% is retained earnings. Okay, so this is what we have, and let's go into the workings on this question then. So let's put a spreadsheet out. So I'm going to do it here. Aim is to get through at least the first part on this question, which I think we should be able to do. So the first part is to look at the financial position, risk, and shareholders' wealth. Now, for the financial position, we will need a P&L extract. So P&L extract, simply think of the current P&L and after 1 year. And within P&L, just put the structure down from the question. We have income, we have cost of sales, we have profit before interest and tax, we have interest, profit before tax, tax at the percentage of 30%, and then profit after tax, dividends, retained earnings. Dividends and retained earnings. The dividends, as we know, are 40%. The retained earnings will be 60% balance. So this is the structure. I've done nothing differently. I've taken the structure from the question, what was given in the question. I'm going to fill up the current values in. So income is 140. Cost of sale is 110, 112. Profit before interest and tax is 28. Interest is 2.8. Profit before tax is 25.2. Tax is 7.6. And profit after tax is 17.6. So just copying the given information. And now I can find the dividends, which will be the C18 into the B20. And the remaining balance is retained earnings, so that is the C18 into the 60%. That is 10.56 retained earnings. So the current scenario is done, the current numbers are done, and now we need to look at after 1 year. So we saw in the question that the income is expected to grow by 5%, so that's the first thing we'll do. So grow this by 5%, so take the C6 into 1.05. C6 1.05. That gives us 147. All workings are in millions and dollars. So 147 is our income. Now you have to be a little careful with the cost of sales again. Let's read that. It said that 40% of cost of sales are fixed, the remainder are variable, and the variable bits will go up. So I'll take the cost of sales of 112, cost of sales of 112, and I will say that 60% of these are variable, which will go in line with the sales of 5%. But we also have the 40% of these which are fixed, which will not increase. So 60% are variable, which will go up by 5%. And then there are 40% which are fixed, which will remain the same. And we get here 115.36. So cost of sales total was 112. 60% were variable. They will go up by 5%. And the remaining 40% are fixed, which means they will remain the same. So the PBIT now will be the D6 minus the D8. You get 31.64. Interest. Now I've got a question here. This business was looking to raise $20 million. This business was looking to raise $20 million using the debt. And they already have some interest expense on their P&L, 2.8 million. My question to you here is this: when they will plan to raise additional 20 million debt, will this interest expense of 2.8, which is already there, will this go away? Or will we, so will this 2.8 go away? Or will we add this 2.8 to the additional financing that we need? So the question is, will this 2.8 there go away, or will this remain there and then we'll add the additional financing? Yes, you're right. Thank you. So right answers here that yes, this 2.8 will remain there, and then we will add the additional financing. Well done. Thank you very much. Thank you very much. So how much will be the additional financing we need to add? 8% interest on 20 million. So what we'll do is we'll take this 2.8. We'll take this 2.8, and then we will add the 20 million, 8%. So 8% of the 20 million, and the 2.8 will remain there. And this means I have got the interest of 4.4. Yeah, right answers going in. Yeah, thank you. The profit before tax now is D10 minus the D12. Tax is 30%. So we'll take now the D14 into 30%. So deduct the tax to arrive at profit after tax, D14 minus the D16. And then I have to split this into the dividends and the retained earnings. So we'll simply do that. We'll take the D18 into 40%, and then D18 into 60%. And that is it. So I've got my retained earnings of 11.44. And this P&L extract in total was 2 marks on this question. So 2 marks for this. So where would these retained earnings go? They will now go into the equity part of the SOFP and will get added onto the reserves. So any questions on this P&L extract first before we go on? So any questions you may have on the P&L extract? Any quick questions on the P&L extract? Okay, some questions on the interest. Well, let's look at this again. The business right now has some non-current liabilities which are $36 million. And the interest that they're paying on these liabilities is $2.8 million. Now, when they will go for additional financing of $20 million, will this $36 million go away? So the answer is no. This 36 would remain there and we'll need to add the 20 million to it. So what will happen to the interest on this 36 million, which is 2.8? Would that go away? No, that won't go away. It will also remain there and will now be added as additional part. So let's look at the calculation again on this. So we took the 2.8 as the current interest and then simply added the 8% of the 20 million, the 8% loan notes, which they are planning to raise the $20 million on. The next question is, will the previous year's retained earnings be added to SOFP? Yes, but the examining team has already given us the SOFP, so I assume that they have already been added onto that SOFP. Okay, all good so far. Let's move on to the idea of the financial position. Financial position. Let's try to think on the financial position now. If I look at this question, the only thing given here is equity and liabilities. I don't have any asset information. That is what I'm going to use here. I'm going to use equity and the liabilities. So current and after 1 year. I have the equity part. We have the shares and the reserves. Equity, so share capital, reserves, total equity. Then we have non-current liabilities. We have current liabilities, and then the total equity plus the liabilities. Okay, so share capital current is 25, reserves are 118.5. The total equity here is given as 143.5. Non-current liabilities are 36, current liabilities are 38.3, and then the total equity and liabilities is 217.8. Now I need to construct this after 1 year. Now I have some questions. The question is, will the share capital change here? So tell me, would the share capital change here when we are looking to raise financing of 20 million? Will the share capital change here? No, yes, well done, agreed. The share capital will not change here. So this will remain as it is, 25. Will the reserves change? Yes, the reserves will change, because what we'll do is we'll take the C28 and add the D22 to it. D22 being the retained earnings after 1 year. So take the existing reserves and add the new retained earnings onto it. And that will give us 129.94. And that means our total equity now will be D27 plus the D28. D27 and D28. Yes, okay. Then the non-current liabilities. The 20 million will be added here. So we'll take the C32 and add the 20 million onto it. That takes us to 56. And there was information in the scenario telling us what will happen to the current liabilities. They will increase by 3%. So simply take the C34 and increase it by 3%. And then add the equity and liabilities, D30 plus D32 plus D34. So I've got my total equity and liabilities as 250, and in this exam there was 1 mark for this. And that's it, the financial position. Any questions here before we move on? Any quick questions here before we move on? Okay, so we can think of the ratios now. A few ratios which we need here in the question. We need debt to equity ratio. Debt to equity ratio. Debt to equity ratio. We also need a bit of interest cover. Interest cover. We need operational gearing. Operational gearing. And we also need return on equity, ROE. Now, please tell the examining team how we are computing these. Debt to equity ratio is simply debt divided by equity. Oops, sorry. Debt divided by equity. Debt to equity ratio. Then interest cover is PBIT over the interest. Operating gearing, the examining team has told us to use contribution over PBIT, so we'll use that. And then ROE is profit after tax over the equity. Over the equity. Now, because the examining team also wanted something on the shareholders' wealth, I can calculate a little DPS. So dividends over the number of shares. Or the number of shares. So these are all the ratios we're going to do. We are going to do these ratios based on the current scenario after 1 year, and we'll show the averages here as well. Well, the averages are given, so 30% is the average here. Interest cover is 10 times. Operational gearing is 2 times. Return on equity is 15%. I don't have the DPS information on average. So let's just quickly do these ratios. Can you tell me that when I'm going to compute the current ratios, which data I'm going to use? So for the current ratios, all these current ratios, which data are we going to use here? Which data are we going to use here when we're going to do the current ratios? What set of data are we going to use here for current ratios? Yes, the current data, which is either given in the question or the one which we have used here. So all this that we have used, we can use all this data and all this data to do these current ratios. So focus on this data now. First of all, debt to equity. So what is debt? Debt is here in the C32. C32 over equity, which is the C30. That's easy. C32 over C30, debt divided by equity. That gives me a gearing ratio, and in percentage terms, it comes out to be 25.09. Then after 1 year, I'm going to do the same calculation, but using the plus 1 year data, which I have computed. So debt is now D32 over equity, which is D30. Well, that's it. Let's see what we get here. 36%, and at this point, I will get 1 mark. 1 mark. Easy, easy. Easy, easy. Interest cover now. The current data in PBIT over interest. PBIT over interest. So where is PBIT? Here is PBIT in C10, and interest is in C12. So C10 divided by C12. So C10 divided by C12. And when we're looking at the plus 1 year, we're taking here the D10 divided by D12. So D10 divided by D12. So here is the interest cover, which is 7.19. And I will get further 1 mark here. Further 1 mark. Then, next thing is operating gearing. The examining team tells me, do it contribution over PBIT. So PBIT is here. PBIT is easy. It's in C10. I have to find contribution. Remember, contribution is sales minus the variable cost. So 60% of cost of sales only. So I'll take the C6. I will take the C6. I'll take the C6 minus the 60% of 112. 60% of 112. So C6 minus 60% of 112. This will give us our contribution. So just so that it is more clearer for you, I'll just do this here. So I'll just do the contribution line here so that you don't make any mistakes on this one. So to work out the contribution, let me just do the calculation part for you here. Contribution, current, plus 1 year. So the current contribution here is going to be the income, which is C6 minus the 60% of the C8. And that will give us the contribution, which is 72.8. And plus 1 year, we'll take the D6 minus the 60% of the cost of sales, which were increased into 60% of the 112, and then we increased it by 1.05. So that will give me the contribution after 1 year. So my contributions are now in G7 and H7, and the PBIT is in C10. So G7 divided by C10. G7 divided by C10. And then H7 divided by D10. H7 by D10. 7 by D10. So I've got my operating gearing now as 2.6 and 2.42. One more mark here for this. Return on equity, profit after tax, we've already computed. This is the profit after tax here, which is in C18 over the equity. So C18 over the equity, which is in C30. So C18 over C30. C18 over C30. So we can show it in percentage. And after 1 year, our profit after tax was D18 over D30. So D18 over D30 over D30. We get our return on equity, 12.26 and 12.31. And then finally, the dividend per share, which is easy. I already got this here. Dividends, which are on C20 over the number of shares, which is 25. So C20 over 25. C20 over 25. Or D20 over 25, the number of shares. And this is all our dividend here. One mark here for this. One mark here for this. And one mark here for this. So in total, now at this point, I've got 2, 3, 4, 5, 6, 8 marks. So any quick questions here on these 8 marks? There are a few marks for comments as well. So I'm happy to take the questions first on the calculations before going into the comments. Okay, so the question is, operating gearing is related to the ability of business to pay its fixed costs. Yes, it's looking at the cost structure. So whichever way you'd like to look at it, how much are the balance of our variable and fixed cost. Sir, we are asked to do the current and 1 year. Yes, that's how the comparisons happen. So we are doing a financial position comparison. So you have to show always the current and 1 year. Why 60%? Because the dividends were 40% and the remainder was also, or are you asking about the cost? Well, it's given in the question that 40% are fixed and 60% are variable costs. Can we calculate the EPS for the assessment of shareholders' wealth? You can calculate the earnings per share. Yes, you can. Although EPS doesn't directly link into shareholder wealth, it's the dividends. So you'll have to justify that and say that EPS is a way to go to shareholders' wealth, but it is not directly shareholders' wealth. Dividends are directly linking into shareholders' wealth. How you calculate dividend share? Well, we just took the dividend, which was in our calculations, which we computed, divided by number of shares. Dividends, number of shares. Instead of DPS, can we calculate any other ratio? As long as it links into shareholders' wealth, which there is no other information really here. So for the shareholders' wealth, it's either the dividends or the share price. Now, quickly, 2 marks worth of comments here, and then we'll close. I have to talk about these numbers. So what is happening to gearing? Current, going up more than average. So what we'll say here is the financial risk is getting higher as gearing is getting higher and interest cover is worsening. Both these measures are poorer as compared to industry averages. Just a comment saying that what is happening to the financial risk. Then about the operating gearing, we can say operating gearing is also falling. Which suggests that business risk is decreasing slightly. Because business risk is operational risk, which is linked to the cost structures. And final point here is that DPS has slightly increased which means that shareholders' wealth is getting better. And that's it. So some few comments here to get my 2 marks on the comments on the numbers that what I have got here. Now, that is it on this webinar. I hope that that was very useful. Any questions, just drop me a line later, and I'll see you then on the session 3.